So good afternoon, everybody, and welcome to today's Direct Energy Business webinar. We're happy that you could join us here today. My name is Dan Tortorello, along with Mr. Tim Bigler, our Senior Market Strategist, who will be presenting today. So a few housekeeping items. During the webinar, just please utilize the question and answer section of your screen to submit any questions that you may have regarding Tim's presentation. Tim will respond at the end of the presentation to those questions that come in. So feel free to ask during the webinar and then afterwards during our question and answer session. Any questions that we may not get to, rest assured we'll reach out to you and make sure we get an answer to you. So without further ado, I thank you for joining us, and I'm going to introduce Mr. Tim Bigler.
Thanks. Appreciate it very much. Thank you for joining us today. Hopefully we'll get a clear understanding of what's going on in the market with both gas and power when you're finished today. And again, if you have any questions, please utilize your function on your machine, and we'll talk to them and try to address them as astutely as we can. With that, we're going to look at a winter review today. Then we're going to talk about natural gas, look at electricity, and then look at some of the regulatory issues that are impacting your region. Polar vortex, I'm sure that we've all heard this word enough times to be able to define it at any moment in time. At the top right, really, the short answer to what polar vortex was when I looked at it initially was it was a river that went off course. In that top right corner, you can see that big dip, or the big expansion of the bubble, as you want to say, dipping down to us. And basically, that circle, green line circle, typically goes around the upper part of the Arctic. The river got off course and brought the cold air down to us, so that was one of the big reasons why the winter weather and temperatures, as you see in those maps, that's the biggest cause behind that. You notice it's the 15th coldest since 1950 for January across the United States, and if you look at the map in February, the belows even expanded with only pretty much the west and the deep south. At the 8th coldest, the impact was natural gas prices in the New York Mercantile Exchange for the forward month spiked up about $6.50. Currently, they're about $4.75. So it was quite a spike, and the price was a 5-year high. So it was definitely a shock to the marketplace what occurred. For the gas and electric regions in New York State, we'll start with the top. You see the electric zones from New York ISO. From west to east, we go from zone A, B, C, over into the zone F, which connects and can deliver power to the mass, down into the zone J and G area, and up into the D. Gas on the lower left, pipelines. You have some long-haul pipelines. The Tennessee pipeline is the purple one. Some regional pipelines with Empire and National Fuel Gas, and then Texas Eastern crossing up into your regions, and then up into Canada, you see some of the Canadian points that connect into New York, Niagara, and Waddington, the Iroquois pipeline. What you're going to see when I show you the next graph is going to be kind of interesting. From power zones, western zones had lower gas power prices due to lower consumption and less gas constraints. More people live on the eastern side of the state. More people live on the eastern side of the United States. Those pipelines got heavily constrained in the wintertime. The western zones of power also have more coal and hydro than the east. So when you see some of these power prices, you'll have a clear understanding of why we have somewhat of a west-to-east bias. Eastern zone had higher gas prices and power prices due to higher consumption of gas constraints. Typically, the last unit in sets the price, and in this case, in the wintertime, it can be oil, $20-some a decatherm. In this case, it was gas prices that were well above $20-some. And then as you're going to see, interestingly enough, zone F, that zone I pointed to there on the right in the center of the screen, in that box, connects into Massachusetts. It can deliver power to ISO New England. ISO New England was heavily constrained this winter, but they did have an oil reliability program. But as you'll see, zone F and ISO New England electric prices were highly correlated. So let's look at New York ISO's monthly report from New York ISO's monthly report. This is what January power prices increased west to east. So what I did for you was to pick the most western zone, zone A there, and look at the prices here. We have day ahead, and then down at the bottom we have real time. And basically there's a day ahead auction that gets set, and then as the market and as weather dictates and power load dictates, basically New York State has 24 separate individual hourly auctions that get bid into 75 minutes before the the next hours occur, and you can get picked up or not get picked up. But so you see kind of a spread there where you have at the top a unweighted price of 106.48. Down below, once the real time came, it was about $98. But as we move through B, we get 100. We'll stick with the real time prices. We get about 101, 98, 107, 113 as we move into zone F. Zone E, excuse me, and then as we move into that capital zone F, which I said to you can deliver to New England, which was heavily constrained for gas, but did have oil, but had high prices, not spiky like we've seen in some of the other regions. Moving through G into the zone J down in New York City, we have 142 type of prices back up to 150s, mid 50s, and then Long Island 178. Dropping down into New England, there really is no zone N, but they just give it a zone just to match up with the way they're set up in New York ISO. You can see that the real-time price was 152, very similar to that capital zone 150.20. So there's definitely a west-east correlation, a little more gas availability in the west, more coal and hydro in the west, so you can see the prices reflected there in those zones, a little bit more constrained, tighter gas markets, more consumption in the east, more gas-fired generation, and prices move up. And then New England and zone F, highly correlated in the peak period there. Just to give you kind of an idea of a different perspective, this is what the market looked like in the day ahead, what we just discussed in zone A, so a different kind of view. And the left side, the blue line, is day ahead prices in New York zone A. You can see they did spike up there in the late January time period. In fact, in early January, they were spiky, but they also spiked later in the month also as cold weather continued. But we use just Dominion South as a natural gas point that can feed into some of those plants out there. And notice kind of the offset between the spikes. We use Dominion South point plus 40, and that differential could be plus 40 up all the way upwards of plus 80, just depending on the market conditions. But notice how the power spikes were different than the spikes that we see for Dominion South, and that's a combination of pretty much a combination of that hydro and coal we talked about, and then space heating load. So you can see that the correlation here is a lot less defined than this correlation. And this is moving across into that zone G we talked about. And zone G can also be very highly correlated with F. And as you can see, we use Tennessee zone 6. So on the right, again, you have prices going backwards. We have prices less than sub 350 in the day-ahead market for zone A. But moving out into the zone G, we see the prices spiked over $450 a decatherm. Gas prices on the right were up close to $70. Notice gas prices here were in the $9 to $8 range. So you can see quite a difference in gas prices and power prices. And notice a much greater correlation here between the gas price and the power price, because gas in this region was definitely setting the price of power where it was not to a substantial degree, is to a lesser degree, excuse me, I can't speak today, to a lesser degree in zone A. That correlation was lower than what you see here, where the blue going up to peak and the red going up to peak were very similar. Moving forward, you're going to see a slide later, we're going to talk about renewables, but I want to give you some insight as to what happened on January 7th. As I was watching real-time power prices, I could also see wind generation in one of the systems we have, and was noticing that all of the wind generation that I was able to see on that day was running at near maximum. This, again, is another chart from the monthly report. This was for January. That is the whole month. So what I highlighted for you was the month of January total wind performance production right there in power. And you notice that blue arrows pointing to January, one of the highest since record keeping began, matched November. I can tell you this, at the very bottom, you see we set a record for power in New York ISO at 25,738 megawatts. On that day, I cut into this piece. This is kind of edited for you. They had a benefit of more than 1,000 megawatts of wind power throughout much of the day. In their own words, there was another headline that came out, without this wind power, New York ISO said they're not quite sure what would have happened. So wind, specifically in the state of, in the New York ISO region, is becoming very, very important. And as you'll see soon, solar, and I'll talk to you in just a second when we get the renewables map, solar is going to become a very important part of it also. But wind was critical for the polar vortex day, and it's been critical through some of the winter, was very critical through some of the winter months. Let's move on now, post the winter, and look at some natural gas markets. Summer basis, we'll talk about the basis first, and that is that pipelines. If you remember, we had that cluster of pipelines on the western region of the state up in that zone A. We also had long-haul pipelines cutting through all the zones, Texas Eastern and Tennessee. Those are pipelines, when I say long-haul, they go all the way down to the Gulf Coast. The basis markets currently are showing somewhat of a differing views of what's going to occur both in the short term and the longer term. Right now we have higher gas supply in the United States, driven specifically by Marcellus and Utica, and even the Southeast with prices over $4.50, which is pretty much the cost to drill for gas down there. That area is gaining, but what we're seeing is the basis markets for May through October, and now June through October, are near their all-time lows. And that is because higher supply year over year, and the potential, I think the market really is looking at the higher supply right now. There's also potential for an El Nino, which I'll show you, which could lead to cooling in the eastern United States. But as we move into Novi March, the market remains uncertain whether or not storage will be filled to an adequate level for even a normal winter. So that's why we say storage uncertainty. And the storage uncertainty comes from, can we get enough gas in the ground before winter starts to make sure that there aren't the kind of spikes we had last winter. And the other uncertainty, obviously, is will it be another cold winter? So certainly as we look at the basis markets right now, when you're pricing up, if you're a heat load customer, unfortunately, most heat load customers that we've seen, anywhere between 65 to 75% of your total cost can be in 3 months in the winter. So the unfortunate thing is, because the winter markets are doing what they're doing, and that is increasing, and most of them are either at or setting new all-time highs for those specific strips. What's going to change that? What will change that is if storage injections start to expand pretty rapidly. Today, every Thursday, unless it's a holiday, the EEI puts their storage report out. It was 82 BCF, slightly above what consensus was. The market came off about 8 cents, but it still remains pretty elevated with regard to the commodity, and the basis markets didn't really flinch a whole lot. Production, this could be the limiting factor when we combine it with weather. On the top left, as I mentioned to you, you are in an area, Marcellus and Utica, you have access to that gas, you have record production. That's what the box in the top left is. Over on the right, though, we are starting to see an increase. You can see quietly, the blue line there is gaining from where it was back in the 2013, early 2014 time period. It's starting to increase. And those higher prices are starting to release some gas down in that region. The West still remains struggling on the lower left. And total gas production right now has hit records numerous times over the last 5 months. So, since November, we have seen a significant increase in gas production. Wellhead freeze-offs at times, notice those dips that you see, have cut that production, but notice how quickly it rebounds. So the good news is you live in an area that, at least for the time being, has a substantial amount of access to the Marcellus Utica gas. The unfortunate thing moving forward is this, and this slide is not meant to scare you, but I can put this slide up from National Fuel. It can be from Cabot Oil and Gas, another Marcellus Utica, EQT, Range Resources, Chesapeake. All of these companies would show you a slide that would look very similar to this. And the unfortunate thing about the PA markets, I'm going to go speak in PA tomorrow in the eastern part of the state, is that projects that are coming online are looking to take gas away from the Marcellus and Utica. The impact might not be as great on the commodity portion of your bill as it would be on potentially the basis. So the takeaway from this slide is that the basis declines that we've seen over the last 12 to 24 months may be the lowest that we're going to see for a while. And I would say that if there's a bias for basis, it's a neutral bullish bias, meaning that prices may not go down further from here and certainly have a risk to go higher. And the projects that are on the boards right now to get built, not all of them will get done. But as you can see the arrows, they're all looking to take gas away from the Marcellus area and PA in that western New York area. You might say, well, what's all the arrows with the going into Canada? There are 2 projects, one of them being specifically a Niagara expansion project, and it is looking to take gas. If you remember in the map I showed you, Niagara over in the far western portion, it's actually looking to take gas into Canada and bypass western New York because Canadian prices right now are higher than what's going on in New York. So Again, not meaning to scare you, but certainly to make you aware of some of the projects that are going on. And they are looking to go north of you, west of you, south of you, and east of you for the time being. And that's the same for anybody sitting in that New York, Pennsylvania type of region right now. Let's look at commodity. Let's drop down to the Henry Hub down in Louisiana. Look strictly just a commodity. These little dots represent each specific month. We always look future, so the contract that you see here in the beginning at this time when it was done was the the May contract, which is subsequently expired. But as you can see, the first 12 months, or the balance of the summer and the into March 15, are higher than they were last year. The black line is current when I just did this on the 29th, and the blue line is 29th of April in 2013. So you can see that as we move forward, though, in that April 2015 time period, April 2015, the black dot, slightly higher. But as we move in time, we are lower than where we were this time last year for the same specific contract. In addition to being lower, they're not substantially, but they are lower. None of the contracts moving forward are above 475, where the contract we had posted here the other day was up over $5. And look at the lower end of these prices, down around the 420 area. To help put this in perspective for you, if I look at some of the negative basis markets I see in the Northeast for the April through October time period, and I take the Henry Hub price around 420 and subtract some of these numbers, I'm very close to coal to gas economics in the southeastern part of the United States, moving up through the eastern seaboard, where coal transport is a little bit more expensive than it is in the Midwest. So the takeaway from this is, and the reason we ask is value is, when you add basis into some of these Henry Hub, some of the regions, and you add the Henry Hub commodity price, you're looking at prices that are being adjusted, imbalances of supply and demand being adjusted by basis and not commodity. The downside, therefore, may be limited as we move forward for the commodity markets, and in fact, they may be value because demand increases, some of the largest demand increases from the industrial sector that are slated for the next 5 years are going to be in the Gulf Coast region, and specifically around that Henry Hub region. So it's just something to think about. They are lower, and so if you're looking forward and asking yourself what's going on, well, we have the potential for a neutral bullish basis. We also have the potential for a shift upwards in these price levels. And remember, you can look at the blue, they were higher just a year ago. Not to say that they can't go back up to those levels again. Let's look at electricity. Capacity has been a big issue in the electricity markets, not only for New York ISO, but for ISO New England, for PJM, and for Midwest Independent System Operator. Capacity is the price paid to keep a generator, have a generator available when you need them to give the power when they're called on. And what you see here is in-city, not typically impacting the upstate New York market, has really surged. And then rest of state has moved up also, very close to 2013 highs. I didn't show the lower Hudson Valley on here, but for those in the lower Hudson Valley, that market cleared, and it cleared right around $10.33 with the default price set by the, and this is kilowatt per month. So basically you're taking the hours of the month, dividing that price by the total hours and multiplying it by 2 for a 50% load factor. And you can see that the price for the lower Hudson Valley, which will begin today, is going to be full in effect. It's being challenged as whether or not it will be a phase-in, but right now, FERC is standing with a full, going all in on the price, and it's about $12 on the default price for kilowatt month versus right now for May, about $18.70 for in-city. So there's certainly a big change between the capacity markets, again, as we move west to east and as we move from north to south. Renewables, as I mentioned to you before, wind was very, very important. If you look at this map by Black and Viak back in January, I thought this was a very interesting map, and I went and double-checked some of the numbers, and they were spot on. New York State, 29% by 2015, leads the East. Not so much in volume, because you can see that the Maine had 30% by 2000, but certainly in the post period where the Tier 1 and Tier 2 renewables, RECs, are in place, definitely New York is taking the lead there. I'm going to speak in Pennsylvania, right below it, only 8 and 10% by 2020, 29% by 2015, very aggressive. On April 24th, Governor Cuomo announced his historic commitment to solar power. This was on NYSERDA's website. $1 billion commitment to solar in the state. So where Pennsylvania, Ohio, West Virginia are relying on fracking, and I'm sure there is some concern in New York State as to will they frack, why we're not fracking, depending on, one's perspective. Certainly, one thing is for certain, renewable portfolio standards are very aggressive, and investments are being made. So it's going to be interesting to see how that plays out. But you will see it, these costs have to be spread out somehow, so it's another cost that's going to be, in addition to some of the capacity charges increasing, to be expected when one looks at their energy budget. What we did here was, colleagues in Pennsylvania and Pittsburgh office helped me with this. It's a very nice presentation about pricing, just to show you. What we did was look from February of 2008 in some of the left side of the box, moving over to 2010 to 2014 time period. Just took prices and looked at the current price. You go from the blue bar down and look at some of the current prices. Where are prices relative, and from a percentile basis, where are the current prices relative to where they've been through those periods we have listed above? 2015, the current price is right around almost 100% of what it was for that period. So you're at definitely the upper band. As you move out to 2015, 16, and 17, 18 calendar years, you can see you fall off somewhat, although 2017, at 99%, you're still looking at a $41 price for energy. So the percentages are kind of misleading because I can be very candid with you. These are some of the lowest prices outside of the Midwest that are in the marketplace right now. So Zone A is certainly, again, getting the benefit of expanded gas production, coal and hydro. While these percentages are high, the overall prices are pretty low relative to what we see around the rest of the country. And as we move into Zone G, look here again, we go through the current price. Let's use the calendars as a marker, 42.57, 40.84, 40s and 40s. Again, we're moving into the Zone G, right? We have 50, almost 57, 53, 53, and then 52, 57. So you can see the percentages higher, prices are higher also. That Q115 we just talked about, as we mentioned, the basis market's really jumping, right? I told you the basis is extremely high right now, setting 2014 highs in some cases for some of these specific regions. Notice $87, almost $88 already when we did this. So quite a difference when you look at $56, almost $57 in Q115 for A versus $88 for Zone G. So again, you can see that west to east price disparity. Let's finish up with regulatory real quick. Here are some of the things that are occurring in the marketplace right now. The Donskomer plant was destroyed by Sandy. It was slated to be basically dismantled, taken apart. The owners of that have come back with the PUC and have requested a review to possibly come back and start that plant back up as a gas, with potentially some oil and some coal. They have been approved for that. The question is, will it come online and when? That could substantially decrease some of the capacity costs we see, and it specifically could really help in that lower Hudson Valley, decreasing the cost down there. But there are other generators who are not so happy about this plant coming on, so it's going to be interesting to see how this plays out, and obviously we'll keep you posted. Indian Point has been a contentious issue also with the nuclear plant. There are those who say it's time for it to cease operation, and those who believe that it's required for reliability. Again, we'll keep you posted. And then renewable, as we showed, New York State taking the lead. There will be a cost associated. What will those costs be? Let's finish it up for you real quick with weather. I would be remiss if we didn't talk about weather. This is the National Weather Service monthly forecast made April 17th for the months. MJJ is May, June, and July. And as you can see, the only area of the United States that's equal chance, EC stands for equal chance, meaning it could be warmer or colder than a 30-year normal. And then below is up in the upper tier of the upper western part of the United States, but basically above normals and a big smiley face across the western United States. The reason I said, will it be this or this, is there are the National Weather Service, the National Oceanographic Administration, the parent of the National Weather Service, issued an alert recently stating that there was a probability that there would be an increase of an El Nino impact, warming of the oceans. And this is the temperature pattern that might occur in that kind of situation. Substantially different. A much cooler east, much cooler south, warmer west. There are three camps. The first camp is National Weather Service, which I just showed you, and they certainly, based on that map I just showed you, are not leaning towards the El Nino at this point. Two other fee-paid services that we deal with are, in fact, leaning one more heavily than the other, but it's the lack of consistency between the forecasters that are out there right now, I think, that is probably keeping the market elevated, in addition to storage, which is a very, very important part of the market this time of year. Storage demand is substantially higher than what it was this time last year. And in fact, if I put this in perspective for you, year-over-year production has been about, year-to-date, about 2 million decatherms a day higher. Storage injection demand just for May through October could be upwards of 4, so 2 times the amount of extra gas that's year-over-year. So it's going to be interesting, and how this weather plays out is going to have a large impact on whether or not storage gas goes to a burner tip for air conditioning load or it goes into the ground. And if it is hot, you're going to need both, because utilities in the Northeast are definitely going to continue to inject as much gas in the ground as they can. We all want to stay cool in the summer, so gas-on-gas competition, i.e. burner tip versus injection, could be very high in a hot environment like we just saw with that other map. It could swing the other way if El Nino was to come about in this map. So let's finish up with a price outlook. The gas power prices west-east bias may diminish somewhat in the future, and it may diminish specifically because of some of those projects I talked about taking gas away from the area, i.e. non-New York consumers want access to Marcellus Utica gas. They want it in the Midwest, they want it up in Canada. Could lead to regional gas price competition. That is definitely a risk. It's further out, but it's certainly a risk. Lower longer-term gas commodity prices down around the Henry Hub may be a value. As I mentioned, substantial portion of the industrial demand growth that is forecast over the next 2 to 5 years is going to be occurring in the Gulf Coast, the Henry Hub prices in the Gulf Coast. Weather risk premiums. Some have asked me, Tim, what do you think about this next winter? What if we have a cold, or what if we have a warm winter? We won't know till we get there, unfortunately. That's the risk that one may have to take if you're looking at some of the basis markets or looking at some prices and you have budgets. Even with this summer, is it going to be hot? We won't know till we get there. Power upside risks, price risks due to capacity increases. I showed you the graph. Lower Hudson Valley came in. It was higher. It was set higher than what the market anticipated initially. So capacity risks are great, but if Donskomer or other issues could occur, possibly Donskomer specifically could help to lower some of that. There is a lower there's a Hudson Transmission, HTP Hudson Transmission project that could change the dynamics of prices also if it were to be fully subscribed. It's like a pipeline. There are utilities, gas generators, who do not lock into long-term commitments for gas pipeline capacity because they're not sure if they're going to run. This pipeline is Hudson Transmission project for 660 megawatts. Only 330 of it have been locked in. If the other 330 was to be locked in, it could lead to lower prices, but unfortunately, that is uncertain at this time also. So, energy budget strategy, what should it include? Right now, the ability to act quickly if power or gas prices decline or increase above targets. And I have to put this in perspective for you. TEDCO M3, again, is that long-haul pipeline that crosses part of the state in the New York area. In the last 5 trading sessions, it's a paper market. It's November through March, winter paper market. It is more indicative probably of a hedging tool or a trading tool. But in the last 5 trading sessions, the price of that structure, just straight, no weighted for load or anything, increased 75 cents per MMBTU. The commodities during that same time period increased about 30 cents. So you can see that the basis markets now, specifically the winter, are also can have significant impact on one's energy budget, specifically if you are a heat load customer. And with that, I'll stop and take any questions, and thank you for your time.
Thanks, Tim. So we'll open it up to some questions. Feel free to use the question and answer section of your screen there to submit some questions, and then after that, we'll wrap up the call.
One question that just came in was asking about the production. We mentioned Marcellus Utica production. What was the forecast for production going forward? It's about a 3% increase year over year for 2014 relative to 13. Production has continued to, Northeast production has set records for gas. It is able to rebound very quickly. There are a lot of projects that are not only looking to take gas away in the future, but currently are looking to strip natural gas liquids out of the gas stream, and those natural gas liquids have allowed producers to get a price uplift and continue to produce gas that may not be economic, might even be break even, but the amount of money that they're making on the liquid. So as we move forward into 2015, the EIA's own forecast in April 14 short-term energy outlook, which comes out every month, we're looking at about another 1 million decatherm increase 2015 over 14. So the gains are certainly expected from the production side. The question is, where will demand be? And it's highly dependent on weather. Next question came about the correlation between when we discussed the correlation between Zone F and ISO New England. Why is that specifically? It's because power can be delivered across that. There's a line that goes across. So New York ISO can deliver into ISO New England, and that's the primary reason, because they can be power short, that those two areas price at the same. Because if ISO New England, is willing to pay X, if you're in Zone F and you're in that area where the power can be switched over to or shifted over to ISO New England, you're going to have to pay X to keep it there. To give you a different example, this year, and I'm not saying for the first time, but it's a rare event. In New York City, gas prices are typically a premium. Because of the expansion of demand south of New York City, in the Mid-Atlantic region, the New York area is Transco Zone 6 zone on that pipeline, and Transco Zone 5 just below it. The amount of demand in Transco Zone 5 has expanded so greatly that they were able to pay or outbid the price in New York, so that if Transco Zone 5 was bidding X plus 10, you had to bid X plus 15 to get the gas to New York. So there's a lot of things that are changing right now, and these regions, that's the gas example, and the region with power is the same type of logic. If one region can pay up for it, then the other region is going to have to pay a higher price to keep it in that zone. A question, will this presentation be available for download or via email? Yes, it will. Another question coming in, what is the feel about how Q4 2014 and Q1 2015 will shape up for Zone F? Here's the good news about that. Good time to lock in now with price. Good time to lock in now with how prices have been trending up. Here's the good news about Zone F. The only RTO or ISO in the United States that chose to use an oil program to back up its power generation last year was ISO New England. It cost $67 million. I will say this, when the final analysis comes in, it will probably be money well spent. Knowing that, some of the spikes in Zone F probably could have been more extreme had ISO New England been more extreme. And no, ISO New England had higher prices, do not get me wrong. But where I was showing you $350 to $450 prices in those charts, they were more like $250 to $300 prices. So my Q1, Q15 tells me that ISO New England is probably going to do another oil program in the 14-15 winter. I think that the Zone F market could be a benefactor from that because they're not having to compete with really super spiky prices. Is it a good time to lock in right now? Unfortunately, the data in the marketplace, we've not really had any kind of relaxation in the weather. So it's a question that I would probably like to answer 2 to 3 weeks down the road, just because to see how the mild weather is going to play with the gas supply going into the storage. Today was a kind of possibly a foreshadowing of what's getting ready to happen to storage, and that is that we had a higher number than the market expected. So I would think that over the next 2 to 3 weeks, pre that June, July, or July, August heat, is probably the time to talk about locking up. That's probably the 2 or 3 week window we're talking about right now. Is probably a good time to look at locking in. Is my short answer to that, which actually went very long.
All right, Tim, thanks a lot. Everybody on the phone, thank you very much for joining us today. As Tim said, we will distribute this via, refresh look there. So we'll have it as a video and also as the slides presented available for use after the fact. So thank you again very much for joining us, and we hope you got some value out of this, and enjoy the rest of your day.
Thank you.